The IRS changed something this year. Not quietly in the background. Not buried in a regulation that only tax attorneys read. They released new forms, new schedules, new filing requirements, changes that directly affect millions of Americans who are 55 and older, and that most of those Americans have never heard about. The 2026 filing season is different from any tax year that came before it. For the first time in decades, the IRS introduced a brand new schedule attached directly to the standard Form 1040. They released new reporting forms for transactions that were never reported before. They updated existing senior-specific forms with changes that alter how your deductions work, how your income is calculated, and whether you owe more, or significantly less, than you paid last year. And here is the part that should concern you immediately. The IRS computers that process your return are already programmed to look for these new forms, specifically and automatically. If your return is missing one of the required new attachments, if you filed the same way you filed last year without accounting for what changed, the system flags it. Sometimes that means a math error notice. Sometimes it means a delayed refund that sits for months while the IRS reconciles the discrepancy. And sometimes it means an audit trigger that brings a level of scrutiny to your tax return that most people are not prepared to handle. According to SavingAdvice.com's February 2026 tax analysis, missing the new forms and schedules released this season is one of the leading causes of automatic flags on senior tax returns. Not because seniors are doing anything wrong, but because they are filing the same way they always have without knowing the rules changed underneath them. If you were born before 1971, meaning you are 55 or older right now, what follows in this video applies directly to you. These are not abstract changes affecting someone else's tax situation. These are forms with your name on them. Deductions you may be leaving unclaimed. Reporting requirements you may not know you now have. And in some cases, penalties accumulating right now on obligations that should have been addressed before June 30th. The single biggest change affecting seniors in the 2026 filing season began with a law passed on July 4th, 2025. It is called the One Big Beautiful Bill Act, officially designated as H.R. 1, Public Law 119-21, and buried inside it, alongside provisions about tips and overtime pay, was something that the IRS itself described as a new deduction specifically for seniors, separate from, and in addition to, everything that already existed. The enhanced deduction for seniors. $6,000 per person. On top of the standard deduction. On top of the existing additional standard deduction that seniors already receive for being 65 or older. For a married couple where both spouses are 65 or older, that is $12,000 in additional deductions available for the 2025 tax year. Deductions that did not exist 12 months ago and that could reduce or eliminate federal income tax liability for millions of American retirees. To qualify, your modified adjusted gross income must be below $75,000 as a single filer or below $150,000 for married filing jointly. You must have been born before January 2, 1961 to qualify. Meaning if you turn 65 in 2025, this deduction applies to you. You must have a valid Social Security number. And if you are married and want to claim the full $12,000 combined deduction, you must file jointly. But here is the critical piece that most seniors filing this year have not been clearly told. You cannot simply write $6,000 on a line of your existing Form 1040. The IRS created a brand new form specifically to claim this deduction. It is called Schedule 1A, and according to the IRS directly, this new schedule allows taxpayers to deduct amounts for tips, overtime, car loans, and the enhanced deduction for seniors. It is a separate attachment to your return. It has its own instructions. It requires its own calculations. And if you filed for 2025 without attaching Schedule 1A, you did not claim the senior deduction, regardless of whether you qualified for it. The IRS confirmed this in its official 2026 filing season updates for seniors published in February 2026. The enhanced deduction for seniors is a provision of the One Big Beautiful Bill Act, and it requires the new Schedule 1A to claim it. The IRS made clear that this is a new deduction in addition to the current additional standard deduction for seniors under existing law, meaning it stacks on top of what you were already receiving, not instead of it. For a retired couple living primarily on Social Security and modest savings, the combination of the standard deduction, the existing senior edition, and this new $6,000 Schedule 1A deduction may reduce their federal income tax liability to near zero. But none of that happens without the form. And if April 15th passed without you filing Schedule 1A, and without you having filed for an extension by that date, the window to claim this deduction without penalty is closing. The second form that caught the largest number of seniors off guard this filing season is one that most of them had never seen before arriving in their mailbox. It is called Form 1099-DA. Beginning with the 2025 tax year, reported for the first time on returns filed in 2026, the IRS now requires brokers to report digital asset transactions on this new form. Digital assets include cryptocurrency, but they also include a broader category of blockchain-based financial instruments that have become more common across investment platforms over the past several years. If you received a Form 1099-DA from any financial institution, brokerage, or investment platform, you are required to report those transactions on your federal return. The IRS has been explicit about this. Taxpayers must report all taxable income on their federal tax returns, even if they don't receive either Form 1099-K or Form 1099-DA. The reverse is equally important. If you did receive a Form 1099-DA, your broker has already sent a copy to the IRS. Their records and your return must match. A discrepancy between what your broker reported and what appears on your return is one of the most straightforward audit triggers in existence, because the IRS computers match these figures automatically before a human being ever reviews the return. Many seniors who have adult children managing investment accounts on their behalf, or who have investment platforms that rolled out digital asset features in recent years, have received Form 1099-DA without fully understanding what it represents or what it requires them to do. Simply receiving the form and setting it aside, assuming it does not apply because you never intentionally invested in cryptocurrency, is not sufficient. If the transaction happened on a platform you use, and that platform sent the form, the IRS has the information and your return needs to account for it. The third change that carries real penalty exposure for seniors involves Form 1099-K, and a threshold change that dramatically expanded the number of people who receive this form for the first time in 2026. 4 years, Form 1099-K was only issued when a payment platform processed more than $20,000 in payments across more than 200 transactions in a calendar year. That threshold applied to PayPal, Venmo, eBay, Etsy, Facebook Marketplace, Airbnb, and similar platforms. Most individuals never came anywhere near those limits and never received the form. In 2026, the IRS implemented the $600 reporting threshold that had been repeatedly delayed in prior years. If you received $600 or more through any third-party payment platform during 2025, from selling used furniture, from renting a room, from any transaction processed through these platforms, you received a Form 1099-K, and the IRS received a copy. This catches seniors in specific and common situations. A retired homeowner who rented out a spare bedroom on Airbnb for a few months to supplement income. A senior who sold furniture, collectibles, or estate items on Facebook Marketplace or eBay after downsizing. A grandparent who received Venmo payments from family members that happened to cross the $600 threshold over the course of the year. All of these scenarios generated a Form 1099-K in 2026 that may never have existed before, and all of them require the recipient to report the income and reconcile it on their return. The important distinction that the IRS has addressed in its guidance is that not all 1099-K income is taxable. If you sold personal belongings for less than you originally paid for them, items from your home, family heirlooms, furniture, those sales typically do not generate taxable income even if you received a 1099-K for the proceeds. But the form still needs to be addressed on your return. Simply ignoring it because the income was not a profit creates a mismatch with IRS records that requires explanation. The fourth area involves Form 1040-SR itself, the senior-specific version of the standard individual tax return, and changes to how it interacts with the new Schedule 1A in ways that affect the standard deduction calculation for seniors who are 65 and older. The 2025 standard deduction for single filers is $15,750. For married filing jointly, it is $31,500. Seniors aged 65 and older receive an additional amount on top of the base standard deduction, $2,000 for single filers and $1,600 per qualifying spouse for married filers, under the existing law that predates the OBBBA. The new $6,000 enhanced senior deduction from Schedule 1A is separate from and additional to both of these amounts. These three components stack. For a married couple both aged 65 or older with income below the MAGI threshold, the combined deduction available in 2026 is the $31,500 base standard deduction, plus $3,200 for the two senior additions, plus $12,000 from Schedule 1A, totaling $46,700 in combined deductions before a single itemized expense is counted. For millions of American retirees whose annual income consists primarily of Social Security, modest pension payments, and interest from savings, this combined deduction may bring their taxable income to zero or near zero. But that outcome only materializes if Schedule 1A is attached and correctly completed. And if April 15th passed without filing, and without an extension, the penalties for late filing begin accumulating at 5% of unpaid taxes per month, up to a maximum of 25%. If you filed for an extension, your extended deadline is October 15th, 2026. The extension gives you more time to file, but it does not extend the time to pay. Any taxes owed were still due April 15th, and if you owe and have not paid, late payment penalties and interest have been accumulating since that date. The fifth and final area that seniors born before 1971 need to understand involves the phase-out of paper refund checks, and a change in how the IRS distributes refunds that caught a significant number of older Americans completely unprepared this filing season. The IRS is actively phasing out paper refund checks. This transition was accelerated in 2026 as part of the agency's broader modernization initiative. Most taxpayers are now expected to provide bank routing and account numbers for direct deposit, and in some cases, returns that would have generated a paper check in prior years have instead been held pending updated banking information. For seniors who have filed paper returns for decades and who expect a check to arrive in the mail, this change has created a significant delay problem. The IRS has not sent these seniors a personal notification explaining that their refund method has changed. The information is available on irs.gov. But the default expectation that a paper check will arrive the same way it always has is no longer reliable. If you are expecting a refund from your 2025 return and you did not provide direct deposit banking information when you filed, or if you filed a paper return and have not received either a check or any IRS correspondence, the first step is to check the Where's My Refund tool at irs.gov using your Social Security number, filing status, and the exact refund amount from your return. If your refund is being held pending banking information, the tool will reflect that status and provide instructions for what to provide. For seniors who have already filed and are uncertain whether any of the new forms were correctly included, or who did not file by April 15th and have not yet requested an extension, the fastest path forward is a consultation with a licensed CPA or tax professional who is current on the 2026 filing season changes. Many tax preparation services are offering reviews of already filed returns specifically to identify missed deductions and new form requirements for this unusual filing season. Here is what every American born before 1971 needs to walk away from this video understanding. The 2026 filing season was unlike any in recent memory, not because the tax code became more complicated in an abstract sense, but because specific, concrete new forms were added that directly touch senior finances. A $6,000 deduction that requires a new schedule most seniors did not know existed. A new digital asset reporting form that generated unexpected mail from investment platforms. A $600 threshold change that brought 1,099K forms to millions of households that had never received them before. Changes to how refunds are distributed that have delayed money seniors were counting on. None of these changes were announced at a town hall. None of them arrived in a personal letter from the IRS. They were published on irs.gov, covered in tax professional publications, and communicated through filing software that most seniors use without fully reading every prompt. The seniors who navigated this filing season without penalties, without audit flags, and without leaving money on the table were not necessarily working with expensive accountants. They were simply aware that the rules had changed, and they adjusted. The extended deadline of October 15th, 2026 still applies to anyone who filed for an extension. The $6,000 enhanced senior deduction is still available to claim for anyone who has not yet filed their 2025 return. The path forward is available, but it requires knowing what you are looking at, and now you do. This video is for educational and informational purposes only and does not constitute financial, tax, or legal advice of any kind. All information is sourced from publicly available IRS publications, official IRS.gov announcements, and federal tax law as enacted by the One Big Beautiful Bill Act, PL 119-21. Tax rules, deadlines, and eligibility requirements are subject to change. Always consult a licensed CPA, enrolled agent, or qualified tax professional before filing or making any tax-related decisions. Federal Decoded is not affiliated with the IRS or any government agency.